This is Macro Horizons, episode 385, August with Angst, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Vail Hartman and Delaney Choi to bring you our thoughts from the trading desk for the upcoming week of August 3rd. And as Warsh is apparently comfortable letting the market do the heavy lifting for monetary policy, we're left with the obvious concerns about the implied spherical logic, reminding us that time is a flat circle, and monetary policy is a state of mind. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market's biggest surprise came in the form of the FOMC decision to not hike rates. Now, that was generally the consensus in the run-up to the event, although a non-zero probability of a 25 basis point hike was priced in. The market's response was a dramatic steepening of the curve, with the two-year sector rallying, but 10s and 30s selling off, the long bond being the decided underperformer on the day. Part of this is a function of the market's reassessment of Warsh as a credible inflation fighter, but there was clearly also an aspect of the move that was positions-driven. Given that there was some chance of a hike immediately ahead of the event, going into the announcement, either short twos outright or with a bear flattening bias made sense. The fact that the committee didn't hike subsequently led to short covering and a re-steepening of the curve. We'll also note that conviction and participation was probably low around the Fed given the absence of forward guidance and the fact that the market is still coming to understand the Warsh Fed reaction function to the incoming data. The FOMC statement itself was all but unchanged, which offers a further data point as to how Warsh will be addressing communication and forward guidance going forward. There were 3 dissents in favor of a rate hike, which begs the question whether or not September is a done deal. Our interpretation is that while September might be a live meeting at this point, the outcome of the next FOMC meeting will ultimately be determined by the performance of inflation over the course of the next several weeks. Keep in mind that by the time the Fed meets in mid-September, the Fed, monetary policymakers, and the market will have 2 additional CPI prints, the data for July as well as for August. So we anticipate that the market will have a higher conviction view ahead of the next meeting. The week just past also gave the market the first look at the Q2 GDP numbers, which came in at 1.5% on a quarterly annualized basis. This was a disappointment versus the 2% consensus. However, the miss was a function of net exports, as we actually saw personal consumption outperform expectations, rebounding nicely from Q1, and the AI build-out continued to contribute to overall growth, adding 1.1% to the number on top of the 1.4% seen in Q1. So with this backdrop of ongoing strength and resilience of the U.S. economy, monetary policymakers have ample time and flexibility to wait and see how inflation performs over the next 2 prints before deciding whether or not a quarter-point hike is warranted.
Well, we've got Warsh's second meeting as chair in hand, and despite the uneventful rate decision itself, during the press conference we saw a significant twist-steepening move and 30-year yields reached the highest level since 2007. In large part, this was a function of Warsh's comment that financial markets have done some of the heavy lifting for the Fed in tightening financial conditions between meetings via the rise in nominal and real yields, which has subsequently raised concerns among market participants about Warsh's commitment to the price stability mandate. The market-implied odds of a September rate hike have dropped near 60% from trending as high as 76% before the meeting. And combined with the re-escalation of tensions in the Middle East that's brought crude oil back above $80 a barrel, the macro backdrop has provided a clear bond bearish undertone for the Treasury market.
And it's an interesting setup for the market as we go into August. Obviously, the payrolls print on Friday is going to be instrumental as investors continue to assess the performance of the real economy and extrapolate the odds for a September rate hike. It is notable that the sell-off in the longer end of the curve was not entirely a function of higher break-evens. Instead, it was a combination of higher real rates as well as break-evens. The increase in 30-year real yields was 8 basis points following the Fed, whereas break-evens widened by only 6 basis points. So this indicates that the motivation behind the sell-off wasn't solely the fact that the market is worried about Warsh's credibility as an inflation fighter. One could argue that as the market continues to understand the Fed's new, if it's changed at all, reaction function to the evolution of the real economy, that Fed Day represented a challenge to treasuries as an asset class, as opposed to simply an inflation story. It's also worth noting that in the run-up to the meeting, the probability of a Fed hike was priced in at roughly 30 or 35%. Pointing to the fact that the market understood that there was a non-zero risk that the Fed would hike, and so from a positional perspective, unwinding a flattening bias via the re-steepening of the curve follows intuitively, and it's certainly reasonable to assume that some of the extremes of the price action that followed the Fed will be faded in the coming weeks, and that's our baseline assumption for the time being.
And returning to Kevin Warsh's comment about the market-induced tightening of financial conditions, essentially the chair's remarks about higher bond yields have raised doubt about the Fed's willingness to follow through on rate hikes to curb inflation. After all, the chair has been talking tough on inflation, but hasn't shown any clear indication to raise interest rates. The issue now is that Fed credibility and the long end of the Treasury curve will remain under pressure if inflation remains elevated and the market lacks confidence that the Fed will raise rates. Said differently, the hawk talk will only be effective for so long if the Fed doesn't back up its words with actions. Letting the market do the work of the Fed isn't a sustainable strategy in the long run, and to some extent, the hit to Fed credibility at the July meeting could incentivize the committee to be more hawkish moving forward to reestablish some of their lost credibility. If the bond market keeps pushing the Fed credibility issue, the committee may be forced to raise rates, and potentially even more aggressively than otherwise might have been the case if their credibility was retained.
And that's a good point. There's also the open debate of what the market was really expecting from a Warsh Fed at July. The case for hiking rates was not emboldened by the June inflation data, nor the June employment report. The argument for hiking rates in July was essentially based on the notion that Warsh's commitment to fighting inflation and getting inflation back to the 2% objective meant that the committee would unwind the 75 basis points worth of rate cuts that we saw in the latter half of 2025 simply because there had been a wholesale rethink of where R* and therefore neutral should be. Barring that, leaving rates on hold until at least September was the most logical outcome, and frankly, the consensus call ahead of the Fed. Clearly, there was a significant contingent in the market expecting that wholesale recalibration higher in rates would lead to a series of 25 basis point rate hikes commencing at the July meeting. If, in fact, the Fed is in data-dependent mode, which is our baseline assumption, then the outcome of the September Fed decision will be determined by the combination of the July and August CPI figures, along with the performance of the labor market in the intermediate period.
And another factor that could be reducing the urgency to hike rates this summer is the impending update to the PCE methodology. The BEA's methodology changes are scheduled to take effect on September 30th, coinciding with the release of the August PCE data. The update will incorporate significant changes to the way that 3 components of the PCE index are calculated: portfolio management fees, legal services, and computer software and accessories. Note that the AI build-out and strong equity performance have been contributing to outside gains in 2 of these categories. Overall, the improved methodologies are estimated to lower recent readings on the Fed's preferred measure of inflation and bring the annual pace of core PCE down by roughly 0.2 to 0.3 percentage points, helping narrow the wedge with other inflation measures like core CPI and other trimmed mean and median measures. The move has understandably raised some concern about political influence, and it's unclear how the revisions will impact the credibility of the inflation series from the market's perspective. If the changes result in a persistent downward bias moving forward, the credibility of the series would likely become a greater issue. For now, the optics aren't great because even if the methodology changes are part of the standard annual revision process, the reality is that the BEA is mechanically lowering some of the stronger components of the PCE index at a moment when the Fed is actively considering whether it needs to raise rates.
The flip side is that there has been a significant wedge between core PCE and core CPI that has been persistent over the course of the last 8 to 10 months, and it's been commented on by market participants as well as monetary policymakers. Therefore, investors might welcome bringing the primary measures of inflation back in line, at least on the margin. That being said, the market is more likely to view this simply as a methodology tweak rather than any concerted effort on the part of monetary policymakers to artificially lower the Fed's favored measure of inflation.
And on the topic of the Fed's preferred measure of inflation, Kevin Warsh started out his press conference by reaffirming the Fed's commitment to the 2% inflation target, although perhaps the bigger issue from the market's perspective was his later hint of a potential shift to the inflation framework in early 2027 after the task forces report back to the committee. Recall that the FOMC reviews its approach to monetary policy at its annual organizational meeting every January. Kevin Warsh also said that he is looking at a broader set of inflation data besides the PCE index and CPI. Together, these comments have reignited concerns about the Fed's inflation credibility, something that's clearly being reflected in the long end of the Treasury market.
And another takeaway from this week's FOMC meeting were the 3 dissents from Hammack, Kashkari, and Lyngen. And those are also the 3 policymakers who dissented against the inclusion of an easing bias in the April FOMC statement. For context, this is the most number of hawkish dissents in favor of a hike since the September 2016 meeting. At that meeting, the FOMC held rates steady in a 7-3 vote, with 3 Fed presidents dissenting in favor of a 25 basis point hike. At the next meeting, the FOMC held rates steady once again in an 8-2 vote, with 2 of the hawkish dissenters repeating their objections to holding rates. At the succeeding December 2016 meeting, the FOMC raised policy rates by 25 basis points in a unanimous vote. And the hawkish contingent on the committee fed into the 1 in 3 odds of a rate hike that were priced in just before the FOMC meeting. It marked the most uncertainty priced into the market regarding a decision since September 2024, when investors were debating whether the Powell Fed would kick off the easing cycle with a 25 or 50 basis point cut. Had the Fed chosen to hike rates this week, it would have marked the biggest market surprise at an FOMC decision on record. But taking a step back, this is still the 3rd largest deviation in market pricing from an actual Fed decision since 2015.
So while we clearly didn't get a surprise, it was nonetheless surprising, at least as evidenced by the price action that followed Warsh. As we think about the week ahead, we have another key event risk coming out of Washington, specifically the August refunding announcement on Wednesday morning.
The update on Treasury issuance comes at a moment when conversations around the federal deficit have been focused on negative net tariff collections and higher defense spending. Monday afternoon's release of the quarterly financing estimates will kick off the supply discussion, and while the release tends not to shift expectations for the following refunding announcement, the market will be watching for any meaningful revisions to the $671 billion projection for Q3. Once those estimates are in hand, the Treasury Department is expected to usher in another quarter of unchanged nominal coupon auction sizes on Wednesday, but the more relevant question will be whether or not the statement retains at least the next several quarters language that has been in place since the beginning of 2024. Recall that the committee discussed potential changes to forward guidance in the minutes for the May refunding, but TBAC did not make any formal recommendations on the issue to the Secretary, as it did in February 2025, when the committee uniformly encouraged the Treasury to consider removing or modifying the forward guidance. Given this, it's still not abundantly clear that the Treasury Department feels an urgency to change forward guidance. After all, the Treasury Department's ongoing emphasis on growing T-bill demand from the Fed and private investors suggests that Bessent has little urgency to move away from utilizing the bill market to fund additional borrowing. Additionally, 30-year yields are now well into five-handle territory and at their highest levels since 2007, and so the administration may want to steer clear of any actions that could add to the bond bearishness ahead of midterms in November. It's worth noting that recent refunding auctions have not been a catalyst for dramatic price action, and we don't have a compelling reason to assume that this time will be different. It's long been understood that eventually coupon auction sizes will need to increase, and presumably sometime next fiscal year. So it's unlikely to be a major surprise to the market, even if guidance is tweaked. Beyond the uncertainties around forward guidance and the timing of the next upsizing the coupon auction sizes, we'll be on the lookout for any discussion of WAM and whether or not certain sectors of the curve will be more heavily favored to meet additional financing needs. Any indication that future increases will be focused on shorter-dated coupons will likely provide a curve flattening impulse, although we suspect that most market participants are already anticipating that the next upsizing will favor the front end and the belly of the curve, given the findings of the Treasury Department's optimal debt model last year.
It is an interesting setup, to be sure. And while we don't expect that there will be any material changes to coupon auction sizes, especially further out the curve, it's an interesting exercise to consider what conversations might be going on between the Treasury Department and the White House, specifically given how high mortgage rates are and the affordability issues that the administration has identified. It wouldn't be surprising if someone was at least considering how the market would respond to cuts in 10s, 20s, and 30s. Now, this is clearly not our expectations, nor is it our call that Bessent will begin to more actively manage Treasury issuance to affect change in outright yields further out the curve, but nonetheless it would be surprising if such conversations weren't being had, even if it is very unlikely that there would be any follow-through. So if nothing else, a more dynamic management of WAM is a possibility.
Wait, I thought WAM was already pretty dynamic. Isn't that like when your playlist goes from Careless Whisper to Wake Me Up Before You Go?
I wonder what's on WAM's playlist.
It's gotta start with Wake Me Up When September Ends.
In the week ahead, the Treasury Department will have the benefit of a fresh round of fundamentals. This time it will be on the employment front rather than the inflation side. And while the inflation mandate is front and center for monetary policymakers, that luxury is a function of the fact that the employment market remains on solid footing. Friday's marquee data release, the payrolls print, is expected to show that in July the U.S. economy added 88,000 jobs. The unemployment rate is seen unchanged at 4.2%, with the average hourly earnings print seen up 0.3%. Positive but benign for nominal wages. We'll be focused on the labor force participation rate, which unexpectedly dropped in June, bringing the unemployment rate down with it. Now, admittedly, there's a fair amount of noise and seasonality within the labor force participation figures, but in the event that we do see an increase in participation, it would follow intuitively that the unemployment rate might be biased higher. Even within this context, however, it's difficult to envision a move in the unemployment rate so dramatic as to shift monetary policy expectations. For such a transition, we would need to see weakness both in the July and August BLS employment series. The week ahead also contains the typical series of payrolls proxies, including Wednesday's release of the monthly ADP figures, which are expected to indicate a gain of 75,000. We'll get Challenger, Revelio, as well as jobless claims and JOLTS. But in keeping with the theme of resilience, investors are operating under the assumption that the labor statistics will continue to demonstrate resilience. The refunding announcement will be interesting insofar as there's a chance that the Treasury Department revisits its forward guidance. although our expectation is that the several quarters language is retained for yet another quarter. We also don't see much reason to anticipate nominal coupon auction sizes will be increased. Specifically, we're looking for 58 billion 30 years, 42 billion 10 years, and 25 billion 30s. All of this incoming data could be secondary in the event that we see a further re-escalation of the tensions in the Middle East. Energy prices are certainly off their local lows, but as the front-month WTI futures contract continues to trade with an 8 handle, the market seems to be content with the assumption that we're stabilizing in a new range for energy costs, and barring a significant deterioration of the outlook in the Middle East, we would expect that that range will hold, with a nod to the fact that there's a great deal of volatility in the hostilities between the U.S. and Iran at the moment. And, as has been the case for the last year and a half, the market will be closely following any posts on social media that suggest either a further downturn or improvement in the situation. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with the arrival of August, we're struck by the nostalgia of summer markets with yields drifting sideways as investors reflect on the year thus far and recharge for the balance of the year. Alas, the last summer that was the case was the last summer we were cool. And even AI can't determine when that was, unless never was a year. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.